All right, welcome everyone. So far in this course, we've really been down in the weeds, right? We've been looking at the mechanics of accounting, the debits, the credits, building financial statements. Today, we're going to pull the camera way, way back. We're going to look at the very structure that makes all of that work even possible, the corporation. You can think of this as the why that sits behind all the what that we do in accounting. We're moving beyond the numbers for a moment to really understand the core DNA of the single most dominant form of business on the planet. And trust me, this isn't just a topic for the law students. The very nature of this entity dictates how we account for everything it does. So let's start with a question that, I admit, sounds a little more like it belongs in a philosophy class. Can a business be a person? Now, hang with me here, because the answer to this question is the absolute bedrock of corporate law, of finance, and yes, of accounting. How we legally answer this single question is what separates your local corner store from a global giant like Apple or Google. Grasping this concept is absolutely essential as you move forward. And to get to that answer, we're going to break down the corporation into three fundamental pillars, the three big ideas that give it its unique power and structure. We're going to start with the one that's maybe the most abstract, but you could argue it's the most important one of all, this idea that a corporation is its own separate being. So here it is, the textbook definition. A corporation has a separate legal existence, but the magic words, the phrase that changed the world, is right at the end, independently of its owners. This is so much more than just a clever legal trick. It's a revolutionary concept. It means the company itself, the corporation, can sign contracts, it can own property, it can borrow money, it can even sue someone or be sued, all in its own name, not in the name of its founders or its shareholders. And for us, in the world of accounting, this is the very reason we have the entity concept, that core principle that says the business is a distinct accounting unit, and its finances must be kept completely and totally separate from the personal finances of its owners. Now, the implications of this are just massive. This separation creates a sense of permanence. Think about it from a practical decision-making standpoint. Let's say you're a manager who needs to approve a $10 million investment in a new factory, a factory that's expected to last for 40 years. You can only make that decision with confidence if you believe the company will also be around in 40 years. Because the corporation is a separate legal person, it has what we call perpetual succession. The owners, the shareholders, can change every single day. They can sell their shares, they can give them away, they can pass away, but the corporation itself just keeps on going. This legal idea directly supports one of our key accounting assumptions, the going concern assumption. We prepare financial statements assuming the business will operate indefinitely. Without this idea of a separate existence, concepts like depreciating an asset over 20 years would make absolutely no sense. Okay, so if the corporation is its own person, a very logical question follows, right? What happens when that person gets into financial trouble? If the company racks up millions in debt, who's on the hook to pay it back? Well, that brings us to our second pillar, and this is the concept that really poured gasoline on the fire of modern capitalism, the liability shield. The definition looks simple, but its power is almost impossible to overstate. Limited liability creates a legal and financial firewall between the company and the people who own it. Every time you see Inc. or Corp. or Ltd. at the end of a company's name, you're seeing this principle in action. It's basically a public announcement to the entire world, to lenders, to suppliers, to anyone, that the owner's financial responsibility for the company's debts stops at a very clear line, and that line is the amount of money they've invested. Let's make this perfectly crystal clear with a quick scenario. Imagine you find an exciting new startup and you decide to invest $1,000 to buy some of their shares. The company goes on to borrow millions from banks to build out its technology, but like many startups, it ultimately fails. It goes bankrupt, owing its creditors, let's say $5 million. So what do you owe? Absolutely nothing more. The maximum amount of money you can possibly lose is the $1,000 you originally put in. The bank can't come after your car, they can't come after your house, they can't touch your personal savings account. Your financial risk is capped. It is limited. And this chart just lays it out in black and white. It really is a tale of two completely different worlds. On the left, you have the shareholder of a corporation. Their personal assets are protected behind that liability shield. But on the right, you have a sole proprietor, someone who owns their business directly. For them, there is no legal distinction between a business debt and a personal debt. If the business goes under, the creditors can and absolutely will go after their personal house, their car, their retirement savings, everything to get their money back. As a future business leader, understanding which side of this chart you want to be on isn't just a minor detail, it is one of the most fundamental risk management decisions you can possibly make. So why is this so critical for you to understand? What's the big picture? It's this. Without limited liability, very few rational people would ever be willing to pull their money into large, ambitious, and risky projects. Would you invest your life savings in a company if you knew that you could lose not just your investment, but everything else you own too? Probably not. This protection is what gives millions of ordinary people the confidence to invest. It's what allows companies to raise the enormous sums of capital needed to build railroads, develop new medicines, or create the software we use every day. If capitalism is an engine, limited liability is the high-octane fuel that makes it run. Okay, so we've built a stable, permanent entity. That was pillar one, and we found a way to protect investors so they're actually willing to put money into it. That's pillar two. But there's a final piece to the puzzle. How do we manage all of that ownership? How do we create a system that's fluid and dynamic that allows money to flow in and out easily? That brings us to our third and final pillar, the idea of ownership in motion. This principle is pretty straightforward, but again, totally profound. It means that owning a piece of a corporation isn't some fixed lifelong commitment. It is a financial asset, a share of stock that can be bought and sold often in seconds on a public market. This concept is what transforms ownership from something slow and cumbersome like the deed to a house into a liquid asset, something that can be traded almost as easily as cash. And that liquidity is a huge part of what makes stocks an attractive investment for so many people. And right there, that is the entire foundation of the stock market. For an investor, this transferability gives them liquidity, the ability to get their cash back whenever they need it. But for the corporation, this is an incredibly powerful tool for raising money. If you're a manager and you need to raise, say, $100 million for a new project, you don't have to find one super rich person to write you a check. Instead, you can issue and sell 1 million new shares for $100 apiece to thousands of different investors all over the globe. From an accounting perspective, this system is what creates the entire section of the balance sheet we call stockholders' equity, and it's why we have to deal with things like common stock, preferred stock, and calculating earnings per share. All right, now for the fun part. Let's put all the pieces together. I want you to see that these three pillars aren't just three separate ideas. No, they are interlocking gears in a single, incredibly powerful machine. Let's see how that corporate engine really works. You can see the logical flow here, right? It all starts with pillar one, the separate legal existence. That creates the stable, permanent vehicle, the foundation. On top of that, you layer on pillar two, limited liability. That's the fuel. It attracts the capital by protecting investors from losing everything. And finally, you add pillar three, transferable shares. That's the marketplace, the plumbing that allows the fuel to flow in and out of the engine, letting it run, grow, and adapt to new challenges. Each pillar absolutely depends on the other two. Take one away, and the whole system grinds to a halt. So as we wrap up our discussion for today, I really want you to lock these three concepts in your mind: separate existence, limited liability, and transferable ownership. This is not just abstract legal theory that you can forget after the exam. This is the fundamental DNA of practically every major company you will ever work for, analyze as an investor, or compete against. A very common mistake students make is to just treat these as definitions to memorize. I'm urging you, don't do that. See them as the strategic principles that shape every major business decision and as the core assumptions that support nearly every accounting rule we're going to study for the rest of this course. And so I'll leave you with this final thought to chew on. We've spent our time today understanding the incredible legal and financial architecture that allows us to treat a corporation as a person. But this naturally leads us to a much deeper, more complex question that will follow you throughout your entire career. If we, as a society, grant these entities the amazing rights and protections of being a person, like living forever and having limited liability, what responsibilities do they have in return? What do these powerful people owe to their employees, to their communities, and to the planet? Now, that is a question that accounting can help us measure, but it's a question that only you, as the next generation of leaders, can truly answer.